All right, let's go. Bank of Canada, 50 points, a jumbo rate drop. It's about time. Ladies and gentlemen, the BOC just did what everyone was hoping for. Well, I don't know, over the course of the last couple of months, over the course of the last, couple of years, the Bank of Canada dropped prime down to 5.95% with most banks, except for TD Bank, who's still for some reason 15 points above the other banks. Go figure. Can't figure why they don't just adjust, but I guess they're too dug in at this point to go any further back. Anyways, for the first time in 2 years, the BOC has put our bank's prime rates at 5.95%. And you wouldn't be amiss if you didn't hear a wide cheer across the nation from all the Canadians who have been suffering with high 6s and even 7% variable rates for the better part of the last 2 years. No doubt about that. Let's get into the specifics today of what happened, why it happened, how it affects you, what's happening with the fixed rate market, and more specifically, what to expect next. So let's dig into the specifics of what Tiff Macklem, the government of Bank of Canada, had to say about our economy and why they reduced interest rates by 0.5%. We'll talk about the impact a little bit further in this video. Right off the bat, let's break into it. Bank of Canada's announcement basically said the economy continues to be in excess supply. The labor market remains soft and inflation is now back around the 2% target, which basically more or less says we have the perfect environment for rate cuts. More importantly, they're trying to avoid any word like recession, even though it looks like that could be the case right now. Now, in addition to that, Macklem basically not only dropped rates with the intention of trying to continue to again stimulate our economy to actually borrow money again, he essentially said we are back into low inflation, reassuring us that things are looking better. But at this point right now, we are still above core inflation at this point right now, which is the number one measure that they're following, is still 0.35% above the actual target rate. So of course, we're not back where we need to be, although he's trying to make us feel like that's the case at this point right now. Now, a couple notes about what's happening economically speaking. And by all means, I am not an economist. My responsibility is to try and understand and educate and share information from you and talk about how it impacts your finances. But let's talk about what's happening right now. I'm going to read through a few key points that we picked up here over the course of the day. So let's talk about what of the economic writers in our country had to say today about the overall markets. They said the economy will remain in a position of excess supply well into 2025, which will continue to put downward pressure on inflation. Accordingly, it seems unlikely to us that the 50 beeps or 0.5% rate cut today will be a one-off. That basically is a suggestion that what the governor, Tiff Macklem, had to say about interest rates is that they're most likely going to continue going down. Although he was very nervous to talk about exactly when that might happen, more so only to say that we might reduce rates again in December. However, the markets themselves are basically suggesting that this is just one of many rate cuts, and in some situations, they're saying it's a little bit too late. Another economist that we pay attention to, David Rosenberg, had something similar to say. He said, the reality is that Canada is experiencing far less fiscal policy stimulus than the US, and that the impact of the prior rate hikes is percolating with far more intensity, seeing as in Canada, there's no such thing as a 30-year fixed rate mortgage. Basically, he's reminding us all that there's a ton of renewals coming up and they're on the horizon with 2025 coming up quickly, and that the BOC has to reduce interest rates to ensure that we don't walk into a crisis when it comes to high interest rates. Now, let's talk specifically about what this means to you if you have a variable rate mortgage at this point right now. I did a separate video that we'll be posting soon about how to make a decision on a variable or fixed in this market. We'll get that next week, so if you subscribe, you'll see it. Anyhow, if you have a variable rate right now, you should note that your monthly payments have gone down by anywhere between $29 to $30 per 100 grand, which is the average depending on your amortization remaining. Now, if you have a fixed payment variable, then the amount that you pay towards interest has gone down, but your payment likely hasn't. Depending on if you increased your payment to the maximum, you might have the ability to actually decrease your monthly payments looking forward. If you have a line of credit, well, then you're paying less interest on your line of credit, which is another welcome sign. And the question at the end of the day for a lot of people is this going to make a significant amount of a difference in my monthly payment, or significant enough that will actually help me to survive day by day? Now, that's a subjective question, but looking at the numbers, we've reduced interest rates by 1.25% since the peak, which is still a long way to go to the bottom, but a reasonable amount to help a lot of families feel a little bit more comfortable day to day with the prospect that rates could go down anywhere between 0.75 to 1.75%, depending on which banks you actually look at as the predictions being reality. Maybe it ends up falling right in the middle at another 1.25%. Either way, that would be a much healthier interest rate, being in the low 4s or high 3s, depending on what your discount is. All right, so what are the breakdowns, the things that you need to know based on what's going on today? Number one, headline inflation came in at 1.6%. Obviously, that's exceptionally low. The bank believes it must bring the policy rate somewhere between 2.25 to 3.25%. Remember, today we're at 3.75%. So there is a wide gap in how far they're willing to go. And depending on which side you believe, we've got a long way to go, or we're almost there. If you're someone on the fence of taking a variable rate, another 1% drop over and above today basically is the jackpot for someone holding a floating rate variable and puts them in a strong position to save money over the term, specifically when compared to most fixed rate mortgages today. So what does that mean for actual rates today? Well, depending on if you're doing an insured mortgage or uninsured, that's more than 20% or less than 20%, the rate range could be anywhere between about 4.75 to 5.15%. There's a little bit of up, a little bit of down, but that gives you a broad range of where rates are at today. Now, if you take an average of $100,000, that would be roughly $30 off per 100, which means over the course of $500,000, which is a very common mortgage size for a brand new mortgager in the country, that's 3 times 5, that's $150 savings per month in terms of total cost. That is very significant. And it might be the difference between people being able to not only survive and make ends meet, but people to get off the fence and start looking at buying more real estate. So what is the impact on fixed rates right now? Well, unfortunately, the fixed rate market has been heavily following what's happening in the US. As far as the US Treasury, the numbers are actually up right now, which is unfortunately pulling up the bond yields in Canada. Therefore, fixed interest rates are not coming down, and we're not actually seeing the same discounts that we were seeing about a month ago in the fixed rate market. That being said, there hasn't been any difference in regards to advertised rates, so the average consumer won't actually notice much of a difference in terms of their fixed rate. You're just not seeing those crazy deep discounts that you were perhaps maybe 30 days to 60 days ago. Now, the other key takeaway is affordability and qualification. Now, when it comes to qualification, this has no impact on people's ability to qualify. And so you might see people run to the markets knowing that, wow, cost of borrowing is going down. We're going to be able to hop in and be able to pay a certain amount less, which is your actual affordability. The qualification for properties really hasn't changed because that's based on the lowest rate available that you qualify for. And so people might actually be surprised to note that they don't qualify for more money, but money is actually more affordable, especially as it relates to variable rate mortgages. So does this mean people will get off the fence and start looking at buying more real estate and borrowing more money? The answer is yes and no. Yes, because you're gonna see more people get back in the marketplace purely because things are moving. We've got fixed rates down 1.5% for the peak, variable rates down 1.25% with room to go. People are looking at the market and licking their chops and saying value has never been better, at least in many parts of the country. There are more buying opportunities and homeowners are willing to negotiate on the price points. On the flip side, we're seeing sellers remain stiff on their house prices, suggesting that they're waiting until the spring market when lots of people jump out to try and buy more real estate with the hopes that rates are down and there's more opportunities in the marketplace. Either way, the stalemate will not last forever, and with affordability going up ever so slightly, qualification not significantly changing, there's going to be more action in the marketplace. Anecdotally speaking, even on my side, I am actually seeing more people reach out, and specifically, not just people reaching out to get pre-approved, but actual live offers, which makes a significant difference because those are the people actually buying homes. A couple points for those who are thinking about getting into the marketplace right now, there's definitely a significant difference now to being able to get subjects and conditions and be able to negotiate, as most properties are selling for under the list price compared to 2 years ago where you had to line up with 30 people, compete against 30 offers, and try to buy a house without an inspection or financing. It's just a better market right now. So even if house prices don't go up, by 10% or 5% from the spring, you're in a better position right now to negotiate and have better terms. I'll be curious to see what happens in the marketplace, and I'd love to know if you're a buyer in this market right now, do you see an opportunity before things go crazy, or do you think this is just another stalling point and we don't see house prices really have an impact by next spring? I'd love to know. Let me know in the comments below. Thanks for watching.